Just because your options trade is approaching expiration doesn't mean it has to end. If a strategy is going well, you can choose to keep the ride going while decreasing cost. Even if it's not, you may want a little more time to see if your original assumptions play out. A trader can choose to roll an options trade, which means simultaneously closing an existing position and opening a new one with a longer expiration and possibly a different strike price. It can provide more time for the underlying stock to move in a way that makes your trade profitable. I'm going to cover a couple of rolling option strategies, including contract specifications like expirations and strikes. We'll also look at some factors to help you decide whether to roll. Traders often roll short option strategies they tend to sell repeatedly for a credit, like covered calls, short vertical spreads, or iron condors. These strategies often rely on time decay to create income, and rolling can potentially be an efficient way to repeat it. Let's look at an example using Amazon. I own the stock, so at the end of August, I sold a covered call with an expiration of October 10th because the stock was nearing resistance. I thought resistance would cause the stock to pull back a little, so I sold the 245 strike for a credit of $3.60, not accounting for fees. Selling the call offset some of the cost of the shares I owned, which functionally lowered the break-even by offsetting potential stock price depreciation by the amount of the credit. In order for the short call to stay profitable, I needed the stock to stay below the strike price. Remember, I still own shares of the stock, so if the price of the underlying increased, there would still be some profit happening on my long stock position. If it rose above the 245 strike, the likelihood of assignment would have increased, and if I got assigned, the stock would have been called away. In this case, the covered call limited my upside potential, or if I closed the call, it may have resulted in a loss. Now, it's October 3rd. It's 7 days from expiration. Amazon stock price is still below the 245 short strike. The Monitor tab shows an unrealized profit of $352.50 or $353 per contract. But as expiration approaches, the ever-present risk of assignment on my short option increases. There's also increased gamma risk or sensitivity to price changes in the underlying. A common way to manage these risks is to exit the trade. But let's say I think the sideways trend appears intact and might be set to continue. I'll look at the November 7th expiration and see what another short call offers. This is a textbook rolling opportunity, and here's why. First, my original assumptions behind the trade were still true. Based on the trend, I thought there could be more potential profit to be had. I just needed more time. Second, I could get a credit to generate more income from this strategy, but the credit may be less than the lost value of the stock I hold if the stock price tanks. Closing out this trade and opening a new one with the same strikes but with more time to expiration could allow me to lock in gains. I could also potentially profit more if I was right about the trend continuing. Now, if there was some bad news about the company that made me want to sell the stock, or if the options on the next expiration didn't offer enough credit to make it worth the risk, rolling may not make sense. Exactly how much credit is worth the risk is a personal trade-off you'll have to weigh, but it's an important consideration. In addition to a covered call, these factors can apply to other strategies that involve selling options, like calendar spreads, where options are commonly sold every few weeks. Selling another option may cut the amount invested in this strategy and lower the break-even point on the trade, reducing the price at which the trade becomes profitable. When I know I want to continue a strategy, rolling allows me to do it in a single transaction, which, depending on the broker, may save on commissions. So I'm going to make that trade from the Monitor tab by opening a rolling order and changing the expiration. The order entry tool shows I could buy back the old contract and sell the new one for a credit of $2.62. Sometimes rolling a trade requires you to choose different strike prices. For example, with a covered call, I may need to change the strike price if the stock is moving higher. Using the same strike price would increase the risk of assignment. Rolling to a higher strike may result in a different credit amount because the credit will depend on the expiration chosen and degree of moneyness. Plus, if the stock is moving higher, I may not get a credit even if I roll to a higher strike. The call could result in a loss. Long options traders may also consider rolling a trade to add extra duration if they think the underlying stock has more room to run. On September 4th, Caterpillar bounced off its 50-day moving average, a bullish signal that led me to buy the October 10th at-the-money 415 call for $13.35 or $1,335. On October 3rd, in this hypothetical example, the call was 7 days from expiration and was worth $8,775, an unrealized profit of $7,440. However, the chart showed the stock had broken above resistance, a possible sign it could go higher, meaning the reason for being in the trade is still there. So if you decide to roll this trade, how do you do that? Going back to the Trade tab, I was considering rolling into the November 7th expiration to try and take some profit and add another 35 days. However, the November 7th 415 strike price cost almost $9,200, which would have taken all of my profit. When trading long calls, we can't generally roll for a credit, but we could lock in some profit by selling the in-the-money October call and buying the at-the-money November call. If the 505 strike is at the money and costs $22, and we're going to sell the 415 call for an estimated $8,855, that would allow us to lock in gains. Rolling to the at-the-money strike from the in-the-money strike could use the profit from one call to partially fund the purchase of the second. Keep in mind, the at-the-money call with more duration may cost more than you earned from selling the previous contract. Additionally, it reduces delta risk, or how much a negative movement can hurt a trade, because we switched out the higher delta call with a lower delta one. When you're deciding to roll an options trade, start by examining your assumptions and make sure the reasons for being in the trade are still there. However, one may consider rolling only if you can get a credit or lock in some profit. Rolling options positions can be one way to manage trades, but sometimes it may be best just to call it quits and look for another opportunity. Rolling a losing trade over and over could result in losses and rack up trading fees. Checking your assumptions, getting a credit, and reducing your break-even could potentially enhance your trade.